All right, Brett, we are live and our participants are starting to filter in. I'd say good afternoon to our folks here on the East Coast and good morning to the rest of the country. I'm here with my friend and associate and extremely talented advanced markets director at Prudential, Brett Berg. Brett, thanks for being with us.
Thank you, Anthony.
All
Yeah.
right, if you haven't seen Brett at an industry event over the last 24 months, you need to get out of the house a little bit more. I mean, Brett's doing 10, 12, 14-day stretches at a time. He is quite literally the face of Prudential's advanced markets team, the author of tons of creative ideas and strategies, and one of the best, if not the best in the business. So we're thrilled to have him with us today. And we did a study group back in September for a small group of advisors. And the one thing that I took away from Brett's presentation, and I asked him if he would do this on a larger scale for us, is that for years we've been living in a world of temporary exemptions, temporary deductions, temporary confidence in our planning assumptions. We would run projections, we would model sunsets, we would hope Congress didn't change the rules mid-flight. Well, Washington finally gave us something we've kind of all been waiting for, and that's clarity. And the one big beautiful bill takes what was uncertain and makes it permanent, right? Top bracket, it stays at 37%. 199A is here to stay. The exemption is finally locked. We can actually do some planning and not convince or scare clients into doing planning. So the permanence doesn't mean our job is done. It means it just got more interesting. And that's the point of bringing Brett on today, to kind of give you a foundation of what took place and then talk about where are the opportunities to move into. Because now the business is no longer about running estate tax projections, although that's an amazing tool that we use on a regular basis through Wealthy and Wise and that Pru uses in their estate tax calculator. But it's more about creating outcomes for families, for business owners, for future generations. And when you create outcomes, pricing typically doesn't matter as much. It's about using this period of stability to move from defense to offense. And I'm a 12-year Vistage member. Well, yeah, 12-year Vistage member. And one of the best speakers I've ever seen was a gentleman on maintaining your value and your margins. And what he said was, if you insert yourself in the very beginning of the process, instead of at the procurement stage, you never have to defend your margin, or you never have to be in a competition, right? Because as this slope kind of starts up here at the value driven very beginning of the process of identification of issues, to down here is where you're taking this referral from an attorney, or you're basically just procuring the coverage, right? It's a completely different experience. So if you can help clients design the future they want instead of just reacting to taking an order, I think you're gonna create much more value and be much more successful. So today we're gonna explore how to do that exactly, how to turn this clarity in the tax code into confidence and having tough conversations. So we're gonna look at some profiles where life insurance can change everything, right? Young families, high income earners, high net worth. So as you listen, I want you to ask yourself, am I helping my clients minimize taxes, or am I helping them maximize outcomes? And that's where Brett's really going to step up and kind of share with us some planning ideas. So without further ado, I'm going to start sharing slides. Brett, want to give us a little intro on Brett Berg and some of the things you want to cover today?
Sure, yeah, absolutely. So it's good to be with everyone. Thank you, Anthony, for having me, and thank you all for your time. And we're gonna dive into a lot today. A little bit about me, as Anthony said, I'm Vice President of Advanced Planning with Prudential. Been with Prudential for the past 15 years. I've been in the industry for over 25 years. I was a lawyer before that. So with all of that said, we're going to start sharing the screen and the PowerPoint that we're running with right now. And we're going to, what's not on the PowerPoint, I think is maybe even more important, but as we move off the title slide there and in the next minute or two, you're going to see some, statistics that just, they blow my mind every time we share them. So as we come up, we're just going to spend a minute on this. You've probably heard a lot about this, but I focus on this because it really dovetails with what Anthony was talking about. We have a massive amount of wealth, whether that 124 trillion that Cerulli is reporting is the number, or whether it's the 84 trillion that has been reported in the past. It's trillions of dollars, right? The greatest wealth transfer in history. You've heard this, right? Platinum age of estate planning. Here's what blows my mind. Clients want more planning. They find planning important, but only 1 out of 3 US adults even have a will. Okay. There's a massive opportunity here. And many of you might say, well, wills and trusts, that's what the lawyers do. Yes, but it's what they need help with. The clients need help putting their plans together. So I'm going to give you 4 things that I think, really are important to think about when you think about value of what you do. You help people organize. You hold them accountable. You can provide great objectivity. Anthony has, this is a Prudential show, and I'm glad to be here. But Anthony, you have access to everybody, right? You have access to all experts in the industry and all products in the industry. So we compete to win every day, and what we want to do is we want to compete in these areas to say it better, show it better, and produce great outcomes and better products for planning and the products that fuel that planning. So let's go to the next slide, Anthony, because I think everyone on this call is probably well familiar with what's going on. We're going to talk about the highlights, only the highlights of the One Big Beautiful Bill. And we're not going to talk about all the highlights. We're going to talk about the personal planning highlights. I mean, I would need, probably 4 or 5 hours to talk about all the One Big Beautiful Bill. There's tremendous opportunity in here from a business perspective and so forth. But from a personal planning perspective, what Anthony said is absolutely right. We have certainty now, right? For the first time since the Bush tax cuts, we have certainty. The top marginal rates remain the same. The 199A deduction is there for small business owners that qualify for it. The standard deduction is what most people take. It's been raised to the limits you see there. And I'm not going to read this slide. You know about the SALT cap, right? We have relief on the SALT cap, but it phases out after $500,000. So what we have to pay attention to, and Anthony's going to talk about this a little bit later, is we have these lower income tax brackets, and we have to make sure that we're taking full advantage of the income that we can kind of fill up those brackets with for after-tax planning, right? Could be allocation to a life insurance retirement plan, could be a Roth IRA conversion, could be a lot of different things, everyone. It's not just life insurance here. It's tax planning, but we also have to be mindful that above certain AGI limits, especially these AGI limits that are kind of tough to stay within if you're on the coast, we have these phase outs of these deductions. So we have to really do some great tax planning with people to maximize their opportunity within the brackets they are and keep their AGI as low as possible to take advantage of the deductions that they have. The headline here is the last part, right? For the high net worth. This permanency in the exemption, $15 million per person, $30 million per couple starting next year. To Anthony's point, what we have is we have some certainty within the tax code. We don't have to model these sunsets and these changes. Now, a lot of you on the phone and on the Zoom will say, but Brett, couldn't it just change in the future? It could, but it's going to be a lot tougher to do, right? We're not talking about just a sunset of a law. We're talking about a change in the law. So permanency in the law and certainty within the law and the confidence to plan, I think that, as Anthony pointed out, are very important themes for customers because it allows us to do this before we go to the next slide. It allows us to ask the questions that really matter to people, right? I mean, for too long, the tax tail has been wagging the planning dog, right? We've led with taxes. We need to lead with planning, what their hopes, their dreams are, what their vision is for the future. And have they done any planning to date? Do they have a will, right? Are they one of those 1 in 3 that have it, or part of the 2 in 3 that don't? Do they have trusts? What do they say? When were they established? Could they be reviewed? Could they be modernized? Could they be optimized? Those are the types of questions that I think are really important today. And it's a reason for you to go out to every one of your customers, if you have not already done so, and said, let's review where you are at today, where you want to be tomorrow. Let's see where the gaps are and see how we can plug those gaps, either planning or product. And it's not just life insurance product, everyone, it's all products in the financial services spectrum. So with that, we've got some slides in here, and I'm not going to dive too deeply today. This is the summary of the key takeaways. And if you're interested, Anthony will send this whole deck out
Sure.
to you, and it's got great speaker's notes. This is the summary. This law should be remembered for what it does not change, rather than for what it did change. It does not change the step up in basis, right? The preferential treatment for long-term capital gains, step up in basis for individually owned assets, right? But remember, if assets are held in an irrevocable life insurance trust and the person dies and those assets are still in the trust, and let's say it's not qualified business stock, qualified small business stock, which gets an exemption. Let's say it's, just long-term capital gain property, real estate, or, stocks, bonds, that kind of thing. Remember that the trust does not get a step up in basis, generally speaking, on those types of assets. So there's a revenue ruling on that point. And if you're interested, we could talk to you offline about that. But what that does is, in cases that I've had just recently, where things have been set up pretty well, right? Except for there's a lot of long-term capital gain property that would not receive a step up in basis in these trusts. What we've done is we've seen liquidity sold to those trusts to partially offset the gain that would be recognized and realized when those assets are sold. So this is very important. Liquidity is extremely important. Think about the recent Jimmy Buffett estate, right? And the what's going on there is that there's a lot of conflict, right? Well, part of that issue, if you dive deeper under the hood, it's not just conflict between the co-trustees, the business manager, and the widow. It's not just that. It's you have to dive deeper into the details. There's a lot of assets within those trusts that are not liquid, right? Therefore, they can't produce the income for the surviving spouse. At least that's the argument that is being made. And I'm going off of public accounts. I'd have no insider information or anything like that. But if you think about it, if that's true, let's just take that as true for argument's sake. What could have helped there? Liquidity, right? And I can tell you in the case that I had with that long-term capital gain property, that was exactly why this person with hundreds of millions of dollars bought the life insurance, for the liquidity in the trust. So remember that step up in basis is still available for individuals, but for trusts, you really have to look at this, work with the attorneys, work with the accountants. I don't practice law on behalf of anyone anymore, neither does Prudential. But what we do is we identify issues that could be an issue. Then we take it to the experts that are advising the customers and say, what do you think? And then how could we make this better? And that's one way that I really see into conversations now, is about that step up in basis or lack thereof in irrevocable trusts. We don't have any changes to grants or grantor trusts. And remember, in grantor trusts, let's go back to the example that I just gave you with those low basis assets in the trust. One of the things that person with hundreds of millions of dollars could do, because it was a grantor trust, is swap assets out, right? Could have done it, because there would have been no tax consequence on that, because it's a grantor trust. The grantor and the trust are the same for income tax purposes, right? And that treatment has not changed. So a swap could have been effectuated without income taxation on that swap, but that's not what that person wanted to do. They wanted to keep those assets in trust for other non-tax purpose reasons, and so they bought the liquidity instead. The rules for valuation discounts on transfer of business assets still are in effect. Very important. We want to squeeze the first step, and you've probably heard this in the industry, right? The first step that we look at is, can we squeeze down the value of the gift for gift tax purposes, right? And then we transfer, and then we leverage, and freeze, and then we, perhaps donate the rest. There's sort of a 4-step process that a lot of lawyers go through when they're looking at this, and the rules have not changed. So we can go on to the next slide, Anthony.
So Brad, I'm going to drop in just one sales idea or concept because I can't help myself. Are you suggesting that during the fact finding or discovery phase, right, that we should not only be gathering clients' personal financial statements and income tax returns, but we should be gathering their trust financial statements and tax returns so that we can do analysis on whether or not they're maximizing their tax efficiency in transfers utilizing those trusts, right?
Absolutely.
There have been
100%.
a tremendous amount of people who have made transfers in anticipation of the sunset.
Right.
What are those assets doing? Are they clipping the highest marginal tax bracket at, call it 15,000 of earned income? Has the asset appreciated? I mean, you can throw a dart at virtually any asset class over the last 5 years, and there has been inflation on that asset, right?
Right.
So if you're not capturing step up in basis and you don't want to swap out those assets, well, life insurance can solve some problems in terms of having to pay capital gains tax on liquidation.
100%. 100%. I think, I'm going to go even broader with my comments, Anthony, just to say this. We should be gathering all of the facts, right? Every fact possible, right? The hard data on what the assets are, where they're located, why the planning was done, because perhaps we want to unwind those trusts, right? That's another issue altogether, and beyond what we can talk about here today with the time that we have. But it's certainly out there, right? So not only do we add assets or change the character of assets within the trust, do those trusts need to be there still, right? That's sort of the foundational question. And then if they do, then are they the most efficient and optimized that they can be? And perhaps we can improve that situation.
Because Brett, at a $30 million exemption, we just have to look a little harder, right?
Yeah,
If you are a planner or a professional, you need to be requesting the right information to identify what the problems are. And if you're not being creative and you're not looking at everything, including trust financial statements and tax returns, you're missing the opportunity, right? So this is
absolutely.
this is the clarity that we've been given, and we need to just dial it in a little tighter to figure out how to complete true holistic planning for our clients and creating opportunities for ourselves.
100%. And before and we can go to the next slide, Anthony, but before I cover sort of the brief history of the estate tax, let me emphasize this in a different way too. When I think about things, I think about holistic planning, which is Anthony's point. What do you need for that? You need all the information. We need it so we have an integrated accumulation plan that optimizes the assets within each bucket, today money, tomorrow money, never money. And we need to focus on effective decumulation for people, right? To gain efficiencies there so that we can focus on transferring efficiently what's left over, which is in many cases a large sum of money, right? So the federal estate tax law, people ask me this all the time. This is going to be a quick slide, Anthony. Could it come back? Well, it's changed over time. Yes, it could, right? But it would have to be now, it would have to be changed, not sunset. It would have to be changed. And it could change, yes, and you can see the history of it there. And I'm not going to belabor this call with all the history, but it's been repealed, it's been instituted, it's been reformed, it's come back, and now we have what we have as a really high exemption amount, right, and a lower top rate on estate taxes. And so, why would it go up in the future? Why would the tax rates go up and the exemptions potentially go down? It's the next two slides, Anthony, and we'll cover this really quickly because I want to be complete for the audience. Yes, I recognize that it could change, right? But if it could change, it's even more reason to plan now and gift now, right? And take advantage of the opportunities now. Why could it change? Because of increasing budget deficits. This bill, even though they did a zero baseline in the Congress, it's estimated to add upwards of $3 trillion to our debt, right? Which is the next slide, Anthony. And so this is not lost on us. We pay attention to this as tax lawyers, and we know that it could change. But again, my point would be is that we have certainty, we have confidence, and if your clients come back to you and say, well, it could change though, and it could go, back down, or maybe they say, well, I don't need it, and you say, well, I have to convince them that it could change. I don't think that that's the conversation. I think the conversation is plan with the tools that you have, with respect to the goals that you know. And let's get tax efficiency in all areas of the client's plan through that holistic plan, that integrated accumulation and decumulation, and optimizing the transfer. I think that's where the conversation is now. And as we go to the next slide, I think that what you'll see, what's important to me anyway, is that we focus on the non-tax issues, right? For most people. For people that are below that 15 million, 30 million per couple, it's going to be about estate equalization. It's going to be about blended families. Anthony and I were talking about this. I had a couple, I'm going to just do a couple of quick stories. And Anthony, I know you have some comments around this. A friend of mine who's an attorney has client conversations all the time. And the way he opens them is, how's everything going? How's that new business of yours, right? Oh, it's great. It's booming. I mean, we're taking off. AI is really transforming what we're doing. We're seeing growth, right? In this economy, and that's really good. That's great. Well, but what's bothering me is I've got one child in the business and another child that lives in California or whatever and out of the business. I can help with that, right? That's what this attorney says. And this attorney uses life insurance to do that, right? Let's put the business over here and let's put a trust for the other child over here, or outright insurance sometimes, depending on whether they have confidence in their ability to manage money. Blended families, another situation, right? How's that? You just got remarried. That's great. Well, yeah, it is great. It's going really well, but my kids from my first marriage don't get along with my second spouse, right? Again, we can help. And this attorney uses life insurance to do that. And these may seem really simple, for this audience. And I agree, they probably are to us. But for customers, this is the first time they're hearing this story. This is the first time to the show. And so what we need to do is just, again, Anthony and I talk about this all the time. We ask the really harder questions, right? About their lives, what their goals are. And we uncover so much in those conversations about, where gaps could be. And then we have to think, do we solve that with just planning, right? Maybe other assets in trust or something like that. Or do we solve it with a combination of life insurance and other assets, or just life insurance itself? So Anthony, I know you have story after story after story in this area.
Yeah, I mean, I think it's just about, right, the question sets and taking the pulse, finding out what's important, right? And it's typically up to the life insurance professional to start asking these questions. I mean, I don't know about you. I have an amazing relationship with my accountant. He's been my friend and always encouraged me to go out and start my own business since I was in my 20s, right? And I'm going to be 50 in a few months. He has never, ever, ever asked me any of these questions. Never. Our attorney, she does a nice job. She doesn't ask the hard questions, right? She's just like, here, present me the facts. I'm going to build the documents around your goals. I have to tell her what the goals are. No one is extracting this information from me, right? That sometimes lies with the life insurance professional because death is personal, equalization is personal, family dynamics are personal. We're getting into those questions. We're also getting into some areas that are really personal with, breast cancer history and, prostate watchful waiting. And, we're getting really personal with clients. So using those tools to flush out what's really important here and then start presenting life insurance, not because of a tax rate, but because it creates outcome, liquidity, control, optionality, peace of mind, right? And this is the outcome tool, not a tax shelter. And Brett, we've been talking about these things for decades, but
Yeah,
we didn't typically have to use them because the economics and the calculators did all the heavy lifting for us. It was simple.
exactly
It,
right.
it was simple. You're worth 12 million. It's going to sunset, right? It's going to be down to five. You have a $5 million exposure at 40%. You're going to owe a couple million now, but 3 decades from now, you're going to owe $20 million. And that did all the heavy lifting. Now we need to get back to our conversations and question sets and really start to get involved with our clients.
Yeah, I think we really go back to the beginning and focus on true planning, right? And and not just tax planning, not just simple math, like you say, but just the aspects of planning that are comprehensive in nature, holistic in nature. That's why the drive for holistic planning, right? And then make sure that we're optimizing in every area. So with in diversifying taxation, building assets, life insurance and retirement planning, repositioning inefficient assets. We're going to talk about all that in a moment.
Mhm.
So the way that I try to think about this is in the personal planning space, especially because business owners, we have a whole host of issues in the business too. So we don't want to forget about those. And Anthony has resources for those. We have resources for those. And we use life insurance all the time in business. So I don't want to forget about that. But I'm focused on personal planning today. So it's young families, high income earners, and high net worth. Where do you fit? And I try to profile these. So with that, Anthony, we can go to the next slide. In each area, I think we have opportunities. For young families, I think the key opportunity is to help them understand how they're protecting their portfolio that they're building, right? Yes, they are protecting income. They are protecting against the debt that they may incur as young families to purchase homes or maybe purchase a business like Anthony, right? He was talking about how his accountant was, encouraging him to have his own business since he was 20. Well, 20-year-old's going to maybe have to borrow, right? And 20-year-old's going to have to maybe have some debt, not only on the personal side, but on the business side. So all those things are true. But these folks are asset builders, they're focusing on that. They like to talk about that. Well, do they have this stock, that stock, what are they invested in, right? This fund, that fund, this ETF, that ETF. And you say to them, well, how about protecting your plan? What do you mean? How about protecting your portfolio? Well, what do you mean? That is what life insurance can do for them just on a term basis, right? And then we talk about, convertibility because they're going to be high income earners at some point, and we're going to go to that slide next. What are they going to convert to, right? What are they going to have the option to convert to? They have pure protection for a while, but then ultimately they're high income, or they're high income and not yet high net worth, the so-called Henrys of the world, right? And what we want to do here is these folks have the same issues as all of the folks in that young family category, but now these folks are looking for another place to save, right? They've maxed out their 401ks. They've maxed out their qualified plan savings opportunity. And by the way, it's better to save on an after-tax basis right now. Historically, tax rates are really low right now, right? We have to keep that in perspective. In the 70s, the top tax rate, well, the highest rate was 90%, but the top tax rate on most folks was 70%. Now it's 37%. Think about that. Pay tax on the seed and not the tree. That's why Roth IRAs are so popular. That's why after tax savings is really quote unquote on sale right now. If you believe that you could be in a higher income tax bracket in retirement than you are right now, and it could happen. I'm not saying it will, because I don't have a crystal ball, but bottom line is providing a way for people to save on an after tax basis and protect against all the things that we talked about in the young family category and what's on the top of this slide is very important. And then when you marry that with the ability to put a rider on these contracts to accelerate the death benefit, if you have chronic illness needs in retirement or after retirement, that's very powerful. Not a whole lot of people still know about this, even though we talk about it, Anthony, each and every day. So we can go to the next slide, and we dive a little bit deeper into the life insurance retirement plan, I think. Or we can
Just
stop.
real quick. Yeah, real quick, Brett. We've taken the initiative to adopt AI tax return analytic tool. And in that tool, we'll scan tax returns, usually a couple of years, provide that complimentary to our advisors. And the tool will give us where you are in the brackets, what your marginal rate is, and then some recommendations. Right. We now get to some pretty significant jumps at between the $500,000 and $600,000 range, because of the knit, because of salt, right? Salt in particular. So your bracket can jump fairly significantly. So, implementing tools like cash balance plans, right? Managing to a lower AGI through above the line deductions can really, really help with some of these high income earners now and then in the future. But I'd also say that, right, the location of the asset is really important. And I think you might start get into this a bit with some actual case studies, Brett. Um, but having the different locations of assets in accordance with tax is as prudent of a diversification tool as your asset allocation, right? You walk into a financial advisor, and I harp on this all the time, right? Perfectly diversified portfolio. We're going to hedge against different outcomes, different industries, different segments of the market. Well, why don't we allocate in different tax buckets, right? Why don't we take that same approach to diversification? If rates are high during a period of your retirement, you can hit your tax-free accounts. If capital rates are low, you can hit your capital assets. If ordinary is low, maybe you go grab some ordinarily taxed asset. It just gives you that optionality that we've been talking about all along. But I don't want to steal your thunder here. I'm kind of walking you into the
Don't
next
steal
slide.
my. I think there's another slide that sort of does a repeat on this one. Yeah. So I like this one. I like the blue, yellow, green. I mean, look, and everybody needs a balance of all of these, especially as we get high income, high net worth. The argument and the suggestion is not to have only one of these buckets. It's to have them in balance, right? It's to say, okay, that blue bucket, that's usually either my today money. I have real estate in there, so it could be a little bit of tomorrow money. It's capital gains money, right? And it's usually today money. I don't have CDs or checking accounts in there, but that also, look, that has to be optimized. I'm not suggesting that we move all of that to the life insurance or to gift it or to do anything of the sort. Nor am I suggesting that we not maximize our 401ks, not maximize our pension plans, to Anthony's point. We need to control our AGI. AGI planning, income tax planning, has become increasingly important over the last 20 years. It is going to be even more important coming into the next 5 to 10 years, right? As we think about ways to keep our AGI low, to take advantage of some of those deductions, which result in what? More cash in pocket, right? More cash in pocket, either on a business side or personal side, means we have more money to invest. We have more money to have fun. We have more money to, yes, I will say it, purchase life insurance, everybody. I mean, some people put off purchasing their life insurance because of their cash flow. After tax cash flow can increase because of deductions, and we should look at that. And, can we implement whatever their plans are to do what they need to do? But the key point is on this slide. If I take $60,000 out of the green bucket, right? And everybody talks about, by the way, Roth IRAs and muni bonds. Almost nobody talks about life insurance unless they really know what they're doing, right? If I can take 60,000 out and it's really 60,000, that's better than taking 60,000 out and paying tax. That's the simplest I can put it, right? And everybody knows that. But what they don't know is that they can do it with life insurance, and they can design life insurance. What does a customer think? And by the way, a lot of their advisors think. They think, no, no, I was told minimize my premium. It's a
Yep.
cost, right? They're not thinking about the benefits, Anthony. So I want them thinking about the benefits. And when we think about the benefits, we design these products in kind of a backwards way. We minimize the death benefit, we maximize the cash accumulation. Anthony's team is very adept at that. You're probably all familiar with that. But remember, our clients, first time to the show, and they're thinking something completely opposite. They're thinking cost and expense versus benefit and tax alpha. They're just not thinking that way. And
Yeah, Brett, I'll tell you another big takeaway from our study group was that one of the participants recommended a book by David McKnight called The Power of Zero, and he sends it out to clients prior to their meeting, and it really speaks about the framework for retirement and tax diversification planning. And to your points, right? Rising national debt, unfunded obligations, or low tax rates. Now, right, the tax rates are on sale, right? We've seen the 24% bracket is massive, right? You can earn up to 396,000 and still be in a 24% bracket. So why wouldn't you take after-tax assets today and create that bucket versus putting 401k and ordinary assets at risk of losing 30 to 60% in certain districts, right? Certain states of their savings to future taxes. So that the book does a really nice job kind of teaching that concept. It's a short read and it's an easy read, and it's amazing for it's been amazing to some of the most successful whole life producers in the country that in setting up future conversations about this subject matter.
So we've got a quick example here with our Custom Premier 2, which is one of our flagship products. It's a VUL product, but to Anthony's point, people sell whole life, they sell, IUL, look, you've got all kinds of products. This really is designed to be product agnostic, but for compliance purposes, I got to put a product in here. So I picked one of the best cash accumulators we've got, 20,000 in, you see the money coming out year by year.
And Brett, no product bias. I think the key here is to just map the asset class to the appropriate solution. So
exactly right.
so if you're heavy in capital assets that are in equities and brokerage, well, why not diversification to a like asset and move and reallocate 3-pay VUL, right? To kind of balance that inequality. If you're in fixed income, then the whole life is a great solution. If you're in a balanced portfolio 60-40, maybe IUL is the sweet spot in the middle. So yeah, it's really about the asset class is really about just mapping, but conceptually, you're nailing it, right? You're creating the power of zero in this example.
Exactly right. So we can go through this example really kind of briefly. You see we do an IRR analysis, and Anthony, I know, is one of the best in the business at, doing IRR analysis on more than just this type of planning. And IRR is important, right? I mean, because we have to see mathematically, is this making sense? And then as we move to the next slide, we show zero because we've got to from a compliance standpoint. It's VUL. So look, this is the payoff slide. This shows you the premiums in, the distributions out. You're optimizing accumulation or helping optimize it, and you can even optimize decumulation. To my point with this, and then you still got a net death benefit, and they're protected along the way, right? Let's not lose that. Death benefit protection has been there to replace the paycheck, right, for a while from that person who dies, for that surviving spouse if something happens to them yesterday. So we've got all of these qualities of this product, and people are really underutilizing it, right? I mean, LIMRA says, the Life Insurance Management Research Association says that we're underinsured by about $12 trillion just for survivor needs alone. So the death benefit side of this, some people will say, well, my customer doesn't need the death benefit. I would say do a needs analysis. Ask all those hard questions that Anthony and I were talking about in the beginning, because I would dare say that most people have a death benefit need for something, right? If it's debt, if it's survivor income or whatever, or it could be taxes, it could be estate taxes. So and maybe they don't, but oftentimes they do. Even the person with the hundreds of millions of dollars had a death benefit need for what? The capital gains taxes that we talked about earlier. So, there's need there. And if there's a death benefit need, then of course, life insurance comes into play. If there's no death benefit need at all, then you're looking at another asset class. So, high net worth. Okay, look, I
checked all the boxes, Brett. We checked them.
Yeah, we're checking all of them. They have all the problems of everybody else, and they have more. They have those taxes. This is the point.
Yeah, let's move into the high net worth.
Let's do it.
Brett. I'm sorry, were you making a closing?
No. Let's move into the high net worth.
All right. So now we can kind of hit that second demographic that Brett has kind of brought to us. We touched on young families, we touched on high income earners. A lot of the folks on the call really kind of looking forward to this high net worth discussion, right?
Sure.
So doesn't it make sense, Brett, to look at like legacy first planning? permanent exemptions, right, finally mean legacy planning can move forward decisively. And we can employ without the maybes or without the potential, um, using grantor trust, using SLATs, using discounted gifts, using dynasty trust leverage, all are still intact, right?
Right.
So, Brett, walk us through the opportunity where we have heard one of your esteemed colleagues um, talk about the golden age of estate planning. It's all here, right? We don't realize, and I teach this a lot. We don't realize we were one vote away in the 499.5% Act of losing a lot of these tools that are available to us that have now been made permanent. So let's dig in a little bit, roll up our sleeves in the last, call it 9 to 10 minutes here. And let's
Sure.
talk about the high net worth demographic and strategies to emphasize.
Well, if you've heard, and I think I know the person you're talking about in the golden age of estate planning, and a lot of people talk about that, but we have a particular lawyer who works with us on some webinars, and he's great.
Absolutely amazing. Yeah.
And he brings frontline experience, and so if you've heard him, I'm not going to retread that ground. I would just say that from an estate planning lawyer's perspective, from a tax lawyer's perspective, it's very important that these tools survived, right? These tools, and they did survive. And so you have them in your toolbox today. And really, if you think about it, I covered this a little bit earlier. I'll start with valuation discounts, because when we're doing gifting, what we want to do is squeeze down the value of the business first. See if there's any way to discount it first, right? And we have the discounting available to us. Still, we have the gifting available to us, not just the annual gifting, but the federal exemption gifting that we talked about. We can sell assets to a grantor trust without any current income taxation result, because the grantor trust and the individual person that's selling are the same. So what we do is we want to say to business owners, sometimes we want to say, look, I know you want control, I got it, but there's a way to divide these interests up into who votes and who controls and who doesn't, and then we squeeze down the value of the assets, or the interests rather, of the people that are not going to be able to vote, or the interests that are non-voting, right, non-control. We squeeze those the value of those assets down, then we sell or gift them away, right? And we can freeze the value that way, and then we can leverage it with life insurance, right? So I don't know if you're familiar with a sale, gift note sale to an intentionally defective trust or not, but I just described it to you, right? I discount some assets, I sell them to a trust, right? At that discounted value, or I gift them, I can gift them too. And then they're in the trust and they're business interests, so they're getting income, right? Now, usually there's a note payable back. That's fine. There's a hurdle rate, a low hurdle rate right now, because interest rates are historically low. And if I'm outperforming that hurdle rate, I have extra money in the trust that's not being gifted, right? I have extra money in the trust to do what? To potentially purchase life insurance, to be reinvested elsewhere, to do a lot of different things, right? That's just one example, right? Anthony, I know that you've got examples of, split dollar and a lot of other techniques that are used out there to, again, efficiently transfer these assets. That's what we're after. And we want to find the money for the premium, either through the gifting or through this income generation off of the gift note sale that I talked about. Lots of different ways. Maybe rolling grats that are emptying into the irrevocable trust at the end of the grat term. If for those of you that are not familiar with a grat is again an estate freezing technique where I make a gift and I retain an annuity interest, and there's a assumed interest rate. It's again very low. If that asset outperforms that hurdle rate, then the remainder passes to an irrevocable trust, and there's a way that we can really squeeze down the gift tax value. I'm giving you 401 estate planning really quickly here. It's not the point to say you need to be the expert in how to do all this. Just know that these tools are available. The gifting, the dynasty trust, everything else. The gifting is very important to leverage, That's the next slide that Anthony was advancing
And
to.
don't forget that step up discussion, right?
Don't
Gather
forget this.
document,
Yeah, let's bring it back.
personal trust, financial
Yep.
statements, tax returns, and let's even take it a step further. Go get business operating agreements, business financial statements, business tax returns. There's a host of opportunities available to us in this world, in this environment.
100%. And let me just cover that really quickly for you before I do the gifting and come back to gifting. Everyone, business owners and what they go through to make sure that their businesses are preserved in the event of a key person dying too early, or recruiting and rewarding and retaining key employees. There's all kinds of ideas here that can maximize the business side of what's going on, which we didn't touch on today. So, there's a whole host of opportunities when you're talking to their CPAs. Are they going to have more positive net cash flow, right, in their business? What are they going to use that for? Maybe they're going to plow it back into their business. Maybe it's time to do that recruit, reward, retain program for their key employees. Maybe that involves life insurance. Maybe it's time to put more life insurance on the business owner themselves or on the key person. All kinds of opportunities that you have. Now, gifting, real quick, Anthony. I've been spending my whole life talking about gifting. People need to understand gifting dollar for dollar outside the estate, all future appreciation outside the estate.
Yep.
Even if you just invest in stocks, bonds, mutual funds, right? But life insurance is so much better, so much more leverage, tax deferral on the accumulation, tax preferral on any kind of withdrawal that I take. So much flexibility, so much possibility, right? People just miss this. But what's most important to customers is I'm going to show them how to leave more to their family and less to taxes. That's what's key for them to remember. And the way that we do that may be technical. The way that we do that may involve these products that they really didn't think of that way. The way that we do that may be new to them. But what's most important is we're going to provide wealth, liquidity. Liquidity is so important, provides flexibility. There's tax deferral. There's that income tax-free death benefit. It helps remove the volatility, right? Because I can have a guarantee that is not correlated to the market. I can have through a number of different products, even on variable products, there can be guarantees. If it's offered on the product, but certainly with whole life and other products that have been sold in the past, you can provide guarantees. And again, estate tax free if it's removed from the estate. These are the fundamentals, and this is what's most important for people who are first hearing this. So I think we've got a case study, and then we'll wrap up with some
Love
other
it.
comments.
Yes, sir. Talk to us about John and Lucy.
John and Lucy are going to do the leverage gift. That's just the
Yeah.
bottom line. They've got a $50 million net worth. They're going to do a $10 million gift. They've earmarked it. So let's just go forward because it just shows you the power. Again, gifting dollar for dollar outside the estate, all future appreciation outside the estate. This is just at 5%, everyone. Now, I don't think the number's shown here, but it's about a $36 million policy that we can buy with that. That's the IRR. The IRRs are tremendous in the early years because life insurance is designed to protect us against dying too soon. But even as we move out towards life expectancy, the tax equivalent IRR, the nominal IRR, still very, very attractive, if we're comparing to other asset classes. So with that, I know, Anthony, you've got some stories about estate planning and flexibility in planning. If you want to share those, or we can go to questions.
Yeah, for sure. And I'll just talk through, Brett, and I think I've stopped sharing. But I'll just talk through some of the tools that we've built around this subject matter. And it's fairly extensive, right? When we're identifying, where are the pain points, in your comprehensive review, when you're fact finding, financial statements and tax returns are key, right? On the personal side and on the trust side and on the business side. In addition to the business financial statements and tax returns, you want to copy the buy-sell of your operating agreement, right? Let our back office leverage your opportunities. What I'm showing you here is an arbitrage between a C Corp owner and the individual bracket. Why wouldn't you just lend the money to the trust in this particular instance? The C Corp's at a 21% bracket. If you were going to distribute it, you'd be in a 37 plus state. Like it makes no sense, but just simple uncovering the facts, right? You find another 49, 49. They don't want to make gifts. They're still building. So we talk about the tax diversification tool. we implement very simply a LERP strategy. The only difference in this particular instance is that the contingent ownership of the survivorship whole life contract, survivorship VUL, any product that you like, the contingent owner is the family dynastic trust. So after you're done enjoying all the tax-free attributes of the policy, you can then transfer the remaining corpus of the contract to your family dynastic trust, right? And there are illustrative tools that we've been building around these subject matters. We have a piece on SLATs. I can go on and on and on, but I think in this partnership that we have, you're doing the fact finding. We're helping you uncover the opportunity. We're strategizing together, and then our team will help articulate the solution in a client-friendly one-page output. So that's you're not peeling through a 50 or 60-page illustration. We're going to consult with Brett's team. We're going to consult with other carriers if Pru isn't a fit or doesn't have that particular expertise. But the reason Brett is here is because he's content rich, he's forward thinking, and he does an amazing job, helping articulate some of these strategies. So, Brett, believe it or not, the questions that have come through, we have actually answered. Either I've typed direct responses to those questions, or you've actually coincidentally covered that subject matter. So we are free of questions at this time.
All right.
We're going to wrap about 8 minutes early. We had an amazing turnout, Brett. You're obviously a big draw. I want to thank you for being with us. We will circulate a copy of the slides, some of our fact finders, and some of the sample outputs that I was referring to. So I want to just say thank you, and we appreciate you spending some time with us. For those of you who are here live, if you're watching this on a recording, we will circulate this recording by the end of day tomorrow. So you'll have it by the weekend. So Brett, once again, my friend, it's a pleasure, an amazing job. And thank you for being with us and supporting us all the time.
Well, our pleasure. And thank you so much, Anthony.
All right. Be well, everyone.